Good morning and welcome to today's webcast, Strategies for COVID Funding Options Available to Tribes. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key.
Today's webcast is eligible for 1.5 CPE credits. Per the National Association of State Boards of Accountancy, to qualify for these 1.5 CPE credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the 6 polling questions. Your attendance and poll responses will be tracked in our CPE progress window. Once you have met all CPE requirements, you will be able to download a copy of your CPE certificate from the CPE progress window. We will also send a copy via email within the next 3 weeks. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. This information is not intended to create and receipt does not constitute a legal relationship, including but not limited to an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. And with that, I am pleased to introduce today's presenters from Moss Adams Tribal Services team, Anita Shah, partner, and Ryan Luetkemeyer, senior manager. And with that, I will turn it over to Anita to get us started.
Thank you, Emily. Ryan and I are super excited to present this webcast to you guys, and thank you guys for joining us. We're always looking for ways to maximize funding available to tribes and tribal businesses, and I think this agenda will definitely show you how you can maximize that. So to start out, we'll be talking about the payroll tax credits that are available to tribes and businesses. We'll share some good news that has occurred on the FEMA front. There's a new Tribal Treasury Emergency Rental Assistance Program. And then being auditors ourselves, Ryan and I will give you some insights on what you should expect from your audit of your CRF program, the Treasury CRF program. And then lastly, we'll be going over some additional funding available that we haven't heard too many tribes take advantage of. And we'll also give a brief update on the stimulus plan. But because you'll be receiving CPE, we have our first polling question.
All right, our first polling question today, who are you representing on the call? A, tribal government, B, tribal business, C, tribal nonprofit organization, or D, other non-tribal organization.
We're hoping most people are within that A to C bucket. This is a very tribal or tribal entity focused presentation.
Mm-hmm. Just another couple seconds here on this first poll. All right, let's go ahead and take a look at the results.
All right, majority is still tribal related. And then the other non-tribal organizations, hopefully you'll still get some benefit out of this then. All right, our first topic is about payroll tax credits that are available to tribal governments and tribal businesses. And every time Ryan and I have tried to have this conversation about payroll tax credits with our tribal clients, the first question or comments that we normally get is that, well, how does this apply to us? Because we're a tribal government or we're a tribal business and we don't pay taxes. So before we move on, we have another polling question for you.
All right. The second question, do tribes pay federal taxes? And your options are A, yes, B, no, or C, I don't know. So Ryan and I were debating on this one because we're like, should we just keep it vague and keep federal taxes, or should we say federal income taxes? Because while it's true, go ahead, Ryan.
No, I think we're going to get to the same thing here. I think that's one of the first questions we get, right? Well, you could take advantage of this, like the employee retention tax credit, but the question we get is, well, we don't pay federal taxes. Well, I guess we'll talk a little bit more about that in the answer, but that's generally one of the first questions that we get when we talk about these credits that are available.
All right, let's see what everyone has to say.
All right, so the yes answer is correct. Tribes do pay federal taxes in terms of the payroll taxes that tribes do pay and tribal businesses pay. Those are federal taxes, and those tax payments are not insignificant. So last year in March of 2020, when the CARES Act was released, and part of that was the CARES Act allowed for this employee retention credit, which is a fully refundable tax credit for employers. And at the time, it said that the tax credit is available to businesses and tribal business concerns, but we weren't sure whether this is applicable to tribal governments and other tribal entities. So finally, on November 16th of 2020, so at the end of the year, IRS and Treasury Department says that, yes, for the purposes of this ERTC, which is Employee Retention Tax Credit, a tribal government or tribal entity is treated as carrying on a trade or business and is therefore eligible for the Employee Retention Tax Credit. So what does this mean to you? From March 13th of 2020 onwards to the end of the year of 2020, tribal governments and tribal entities with over 100 full-time employees can apply for the tax credit if those employees were paid wages at the time they were not providing services. So for example, wages paid to employees that were asked to stay home due to shelter-in-place orders, or that were unable to work or telework, or if admin leave, administrative leave was paid to employees and they were not working, or even furloughed employees that still received health plan benefits from the employer. So if you have over 100 full-time employees, then this is the criteria for that. Now, if you have less than 100 full-time employees, then this tax credit is applicable to all wages paid to your employees. So even if they were working, for the over 100 employees, it's a little bit more narrow. So it's more beneficial right now for 2020 for tribal governments and tribal entities with less than 100 full-time employees, because the ERTC can apply to all wages paid to them. In 2021, this 100 employee count now goes to 500 employees. So a lot more tribal governments and tribal entities that have been paying wages that in this year, in 2021, are paying wages to employees while even if they're working, they would be eligible for this tax credit. And the wages that are calculated for the tax credit also include not just their normal wages, but also include any qualified health plan expenses that are incurred by the employer. So one qualifier on this employee count, the IRS mentions the aggregation rules, wherein you would calculate the total employee count based on the types of reporting entity, the type of reporting entity structure you have. So the IRS does say, it explicitly says that tribal governments and tribal entities should use a reasonable, good faith interpretation in determining how the aggregation rules apply. For a tribal government that has tribal businesses that are operated separately or are separately managed and separately operated for business or organizational reasons, then the aggregation rules may not apply. The reason is that the aggregation rules are primarily to address anti-abuse rules. So if a single business is artificially split, then that's what the aggregation rules are geared towards addressing. But just because a tribe is the ultimate owner of a business, that may not automatically trigger this aggregation rule. The reason we didn't include that on our slides, the aggregation rules and how this affects each tribe, is that it's very much based on a case-by-case basis on how the tribe is set up how the tribe has set up its different businesses and different entities. So definitely take a look into that to see if you guys at, say, a tribal entity or tribal business would qualify under this under 100 full-time employees. So how does your tribe or your tribal government or tribal business become eligible for employee retention tax credit? Well, there are one of two criteria that you would need to meet. It's an either or. So either you meet the first criteria of if the tribal government or tribal business had fully or partially suspended operations due to orders from an appropriate government authority due to COVID, then you would become eligible for this tax credit. Now, we've received many questions on what an appropriate government authority is and whether a tribal council would be allowed, would be considered an appropriate government authority. And per the IRS, the list that you have in front of you are the orders that IRS is allowing. So it could be an order from the city's mayor. It could be a state's emergency proclamation of a shelter-in-place order. It could be an order from a local official imposing curfew on residents that impacts operating hours of the trade or business, or it can be an order from a local health department mandating a workplace closure due to cleaning and disinfecting due to COVID. So this third bullet that talks about the local official, that would be equivalent to a tribal council order. Now, the guidance does say that this ERTC, you can be eligible for it if you have full or partial closures. So, for example, for casinos that have entertainment venues or restaurants, they may have had closures or they may still be closed. And in those cases, because they would qualify as a partial closure, they would meet the ERTC eligibility requirements. Also, if a tribe or tribal entity or business has had to reduce its operating hours due to a government order, then it would still be considered a partial order. So you can meet any of these criteria. There are these criteria to be eligible for ERTC, the full or partial closure under these government orders. The second criteria under ERTC, so it's either full or partial closure, or if your tribal business, tribal operations has experienced a significant decline in gross receipts during the calendar quarter in 2020 compared to 2019. This can get a bit tricky. So in 2020, you would start your eligibility for the ERTC if your gross receipts were less than 50% of the gross receipts in the same calendar quarter in 2019. This is when you begin your eligibility for ERTC. So you would think that if that's when it begins, it would end when you go above 50%. That's not true, because IRS doesn't like to make things easier for us. But they did make it a little more generous. So what they did is, it's not as soon as you go above 50%, but in the quarter that you have gone over 80% of 2019's gross receipts, that quarter after that quarter is when you would become eligible for, that's when you would end your eligibility for ERTC. And I'm going to go over an example of that in the next slide to kind of walk through this a little bit more with numbers to make more sense of it. Just really quick, for the 50% and 80%, that 50% really applies to 2020. In 2021, because ERTC has been extended from January 1st to June 30th of 2021, and that they've made it a little bit more easier to get ERTC. So it goes from 50% to now 80%. So you would become eligible in 2021 if your gross receipts are less than 80% of your gross receipts in 2019. So that's for 2019 or 2021. So let me go over this example to make a little more sense of when your eligibility starts and when it ends. So if you look at the quarter ending 3/31, revenues were 48% of 2019. In 2020, revenues were 48% of what it was in 2019. That means you've gone under your 50% mark, and now for quarter ending 3/31, 2020, you are eligible for the employee retention tax credit. Now, for the quarter ending 6/30, your 2020 revenues are 83% of 2019. So now you've gone over the 80%. So your eligibility for ERTC will end not on 6/30, or it will not end for 6/30, but it'll end on that quarter ending September 30, 9/30/2020. So it's the first quarter that follows the first quarter where gross receipts are greater than 80% compared to the same calendar quarter in 2019. So your ERTC eligibility would end the quarter after it goes over 80%, which means in this example, you would be eligible for your ERTC on March 31st, for quarter ending March 31st, and for quarter ending June 30th. So as soon as you hit 80%, or as soon as you go below 50%, it kicks in, and then as soon as you go over 80%, the quarter after that, it ends. So that's how you would calculate the timing of when you're eligible for ERTC. Remember, you only need to meet one of the two criteria. Either you meet this revenue significant decline criteria, or you meet the criteria of whether you had full or partial closures of your business to become eligible for ERTC. So now that I've gone over the timing and eligibility on how to become eligible to receive this tax credit, here is an example of how to calculate your ERTC and how much you can claim. So the law says in 2020, from March 13th to December 31st, the credit is equal to 50% of your qualified wages paid to an employee, up to $10,000 per employee for the year. So 50% of $10,000 of wages would be the maximum amount of credit that you can calculate is $5,000 in 2020. So this example in front of you is for, this is just an example, it's for a business closure from March 19th, that occurred between March 19th, 2020 to June 2nd, 2020. So this can look like a lot of numbers, so we're just gonna go through a couple line items first. So if you look at employee 488, that employee's payroll, their total payroll was $7,560. Then the business also incurred qualifying healthcare expenses of $1,512. So the total qualifying wages is $9,072. Now the wages, so the 50% of the wages up to $10,000 is what the ERTC law says. So total ERTC for employee 488 would be $4,536. Now for employee 489, you can see their payroll was higher. It was $12,869. Their healthcare expenses were $2,573.80. So their total wages are $15,442.80. However, the ERTC maximum amount that you can consider for qualifying wages is $10,000 in 2020. So the maximum ERTC you would get for this employee would be $5,000. So if you just look through the next few employees, for employee 490, their total qualifying wages was less than $10,000, so that you calculate 50% of that. For 491, their total wages was more than $10,000, so you can calculate the maximum of just $5,000. So if you go down the line, the total employee retention credit that we've calculated for this example would be for that business that they can claim would be $645,611.52. So that is the amount of refund that the business can get, or they can apply it to the Social Security taxes that they would be paying in the next quarter. So the way you would claim this refund or tax credit is that you can retroactively claim this using IRS Form 941X for each quarter starting with quarter 2 of 2020. So that's for 2020. That 5,000 limit and 10,000 qualifying wages limit is for 2020. For 2021, they have expanded that to make it 70% of 10,000. So you can 70% of 10,000, $7,000 per quarter. So for 2 quarters, so right now the ERTC goes to June 30th of 2021. So if you have any sort of business closure, partial or full closure, or if you had a decrease in gross receipts of 80% compared to 2019, you would get your maximum amount of credit you could get for both quarters is $14,000 per employee, which is significantly more than the $5,000 per employee in 2020. But even for the 2020, you can see that's not a small chunk of change. So there's a lot more eligibility in 2021, but for 2020, I don't want to ignore that either because it adds up to quite a bit. And what they're talking about in the new stimulus plan is that they may extend this ERTC all the way to the end of 2021. So you might even have more options for this. So that's an example calculation for your employees for a business closure between March 19th and June 2nd. So now that we've talked about timing, eligibility, and the calculation of ERTC, other than the obvious benefit of getting, a not insignificant amount of refund on this tax credit, another reason to apply for this is that the tribal governments and tribal businesses that benefited from the coronavirus relief funds, the Treasury's FAQ clearly states that if you incurred more administrative leave than what is normally expected, then you can cover this leave with CRS money. We know quite a few tribes that paid administrative leave to employees to stay at home due to COVID. We know casinos and other businesses that continue to pay wages to employees even when they were not working during their shelter-in-place orders. So we also know a lot of tribes use the CRF money to cover for that admin leave. So if you take advantage of this tax credit, you would be able to free up the other program money that was charged to cover this leave. I'm going to show you another example of how that can work out for you. But before that, a quick reminder on double dipping. So it's pretty simple. You can't have the federal government pay for the same expenses twice. So for example, if you have expenses that have been covered with federal funds, and if you get a tax credit, that means it's been paid twice. So you'll have to reduce these costs that were charged to the federal funds, and then you'll have availability of that funding. So here's the example. Suppose you had administrative leave that you charged to the Treasury CRS program and you reported into the grant solutions in the amount of $1.6 million. Now, based on that example that I showed a couple slides ago, your total employee retention credit based on your calculations, you would be getting a refund of $645,611.52, which means only $968,000 would be what you would need to charge to the CRS program, because now you have that credit, so you would decrease the amount of charges to the CRS program, and now you have $645,611 available to pay for other CRS eligible activities or for other CRS eligibility activities. This applies not just for CRF, of course, if you use BIA funding or if you use even your tribal hard dollars for this leave. You would basically make that, you would be able to use that available funding for other purposes. So the deadline to file the revised 941X form is within 3 years from the date that you filed the 941 form, or within 2 years from the date you paid for the 941 taxes, whichever is later. However, in order to free up your CRF money or even other federal program money to use in 2021, or if there are other deadlines for other federal programs, you probably want to take advantage of this tax credit sooner rather than later, because now you have until the end of 2021 to use the CRF money. Same thing, even if it's BIA or other funding that you use, you may want to reallocate that as long as it's within the period of availability purposes, you can use that. So this was the first tax credit. Ryan is going to talk about the second tax credit available to governments and businesses.
Thank you, Anita. Nice to be here. I know throughout the country, a lot of people are getting snowstorms. So if you made it here and you're comfy in your house watching this, we're going to get into the Families First tax credit next. So this particular credit and this what we call Families First was actually passed before the CARES Act, but throughout last year, we really weren't certain if this was applicable to tribal governments, and if tribal governments could receive tax credits for the qualified sick leave and family leave related to COVID type matters. But then, over 7 months later, on November 25th, the IRS did weigh in and indicated, yes, that tribal governments that do provide paid sick and family medical leave related to COVID are eligible to claim tax credits for that leave. So which is great, really great to hear. But now we're kind of, having to go back into history and say, okay, well, look, is any of this time that employees had leave on, is it eligible for these type of tax credits? And we'll cover that here in a bit. But I think the big thing about Families First is that it does dive into the labor laws. And so these provisions may or may not apply to your tribe. You might not be, for example, with the Family Medical Leave Act, your tribe simply maybe doesn't follow that because it's the sovereignty issues there. So it's definitely important. If you think that Families First, after we talk through this, if you think that it might be applicable to you, you might want to work with your attorney just to understand, again, how these regulations impact your government before moving forward, okay? So let's talk a little bit about what Families First, what we got here. So essentially, for the periods of leave beginning on April 1st and ending March 31st of this year, you really have to look at first, if you're an employer that has under 500 employees, this credit may apply to you. So that's the marker, right? So if you're over 500 employees, you can't take advantage of this. So want to get that right off the bat. But I think it's also important to note that in determining the number of employees, it could be a bit more complicated if you have a number of separate legal businesses or enterprises like casinos or development authorities. Those aggregation rules that Anita brought up previously also apply here as well for determining the total number of employees. So again, like Anita mentioned, the aggregation rules really looking at if there's common management, what degree of financial control does the government have over the various businesses. So a lot of those factors are considered when you're looking at this. So, but could be pretty sizable credit overall. But just moving on here. So again, the credit, and we're going to talk a lot more about this, but the credit is applied to the qualified sick leave and family medical leave provided to employees that were due to COVID-related reasons. You've likely, and I've seen this a lot with tribes, you've likely already provided this type of leave to your employees, but just didn't realize that you can get reimbursed for it. Again, we didn't really know about it until late November anyway, so it's important to note. And then finally, the credits are generally easy to obtain by simply performing the calculations on worksheet 1 of Form 941. If you believe you did have qualifying employee leave subject to these tax credits, but already filed that quarter's 941. As Anita mentioned previously, very similar process with ERTC credits. You can amend that quarter's 941, and you have a 3-year time period to do that if you did have eligible leave during the required time period of the Families First Act. Okay. Moving on. Let's dive into Families First. Let's see how, if you're still staying tuned because this is applicable to you, we're going to talk a bit more about the details. So the qualified sick leave is really, again, there's 2 points to this. If you, as a tribe, are following Families First, then you have to not only follow the requirements of providing leave, but also, again, you're eligible for the tax credit. So employers that pay their employees their full rate of pay for 2 weeks of leave during which the employee is unable to work because that employee is, subject to some type of federal, state quarantine. They're advised by their doctor to quarantine as a result of COVID, or if that employee is simply experiencing any symptoms of COVID, that particular leave is eligible. So that 2 weeks that you provided to that employee is 100% provided, refundable to the tribal government through these tax credits. But there are some limitations. There's some income restrictions. There's maximum amounts that you can claim based on what we have here. But overall, it could be a sizable refund, especially during those first 2 weeks of leave. So continuing on with sick leave, if the employee needs to care for others due to COVID, this credit is available at 2/3 that employee's regular rate of pay for that first 2 weeks. Okay. So again, previously we talked about the employee having sick leave because of the COVID symptoms that impact them directly. But if that employee is unable to work because they have to care for somebody else, caring for an individual who's subject to COVID isolation orders or advised by their doctor to quarantine, or if that employee needs to care for a child because the school is closed, provider for that child care is unavailable due to COVID precautions, essentially this, the remaining sick leave could be, if they're caring for others, could be provided at 2/3 their regular rate of pay for that first 2 weeks. So again, subjected to very similar limitations in regards to the total amount per day. Okay. All right. So the other area is now the qualifying family leave wages. Okay. So to be clear, the sick leave wages that we discussed previously applies to the first 2 weeks of that leave. Now, the qualifying family leave wages apply to the next 10 weeks, okay? And so, again, if the employer is paying employees for leave, again, at 10 weeks at least 2/3 their regular rate of pay, during which the employee is unable to work, again, similar criteria. They're caring for a child because the school is closed. Even if, during summer, they had to take care of their child because the summer programs were canceled. Or, this is a big one too, is that the employee's childcare provider is just simply unavailable for reasons related to COVID. For up to 10 weeks, you can get a credit for that time in as well. So subject to the maximum thresholds that I noted here on the slide. Okay. So let's go through the quick calculation of these credits. Note that this is the same payroll register that that Anita covered during the ERTC discussion, right? But now we're going to consider these Family First credits. The IRS does discuss in their FAQs that you can claim credits available under Families First for this paid leave, as well as ERTC, but they cannot be for the same wage payments, okay? It's also important to note that employers can provide both qualified sick leave and family leave and claim tax credits for those, but it cannot be for the same hours. So again, a very important concept that we really need to factor in is not only double dipping, but just, what hours are we claiming and what wages are we claiming for which credit? Okay. And also in regards to this particular schedule, it's very important to note that this schedule covers the administrative leave. Since the business closures occurred on this example on March 19th, as we previously discussed. But it's very important to note the Families First leave is only applicable from April 1st and subsequent. So April 1st is really the key, right? In this example, another key point, you'll see the employees that we have here in this example. We're barely below that 500 employee threshold. So again, in this particular example, the tribe is an eligible employer. So the payroll off to the left part of this example, the payroll and qualifying healthcare expenses are exactly the same as the ERTC example. But now we're having to factor in the employees that had qualifying sick or family leave wages during that same time period, right, after April 1st. So as you could see, just real quickly on that example with employee 489, after going through this and identifying that we did have, in fact, employees that met these criteria within Family First, that this particular employee had 2 weeks of sick leave due to COVID-related reasons. The wages in this example for this employee were not the same as what we're claiming for ERTC. So in this example, we can claim 100% as a tax credit, which is the $3,540. But then the remainder of the wages during the business closures still exceeded that for the ERTC credit, the $10,000 of maximum qualifying wages, which results still in the maximum credit for that employee of $5,000. So again, it's just overall a strategy to, I hate using that word often, but maximizing the credits that are available to you as a result of the pandemic. So just a quick example showing you that. All right, so this next slide, and you saw this before when Anita was going over it on the ERTC, but now since we've factored in, the eligible tax credits for Families First, let's see how we've maximized the available funding from the administrative leave that we had originally charged to the CRF funds. So after tallying all the credits up and going through the calculations, now, again, initially we had in the CRF fund claimed administrative, sick, and other types of leave that we paid to employees to the CRF fund. But now, again, after November, we realized, well, the tribal government is eligible for additional tax credits. So now we're able to go back and now claim the Families First credit, which we got of $275,000. And then we have to readjust what Anita had previously done on the ERTC credit, although the ERTC credit that we calculated here is reduced because we're, again, maximizing the Families First credit. So at the end of the day, what we have is now we have, after we factored in the updated ERTC credits, now we have $828,000 to apply now to the CRF. So essentially, bottom line is that going through this process with this particular example, we were able to maximize credits of $785,000. Again, all that money could be reallocated to other the leftover amount to the CRF you could use in 2021 for eligible purposes. And then the great thing too about the credits, both of these, although they are federal, tax credits, they are not they're not considered grants. They're not subjected to a single audit. It's essentially your money. So anyway, really, really good stuff here. I think it's a tax credit that tribes really should be at least looking into to see if they could utilize that. All right. So just real quick, just continuing on here. So the impacts of these credits. So we've talked about the fact that the expenses were for this type of leave were originally allocated to the CRF fund. And all of the previous reporting, if you were applying it to the CRF fund, all the previous reporting within Grant Solutions addresses the administrative leave. Okay. But the Treasury Department did indicate that, and acknowledged in their FAQs that they expect that there's going to be alternative sources of funding that might cover these costs later on down the road. So here, I think it's important to note the FAQ that's here, that you can't go back in time and update the grant solutions reporting, but Treasury does allow you that if you are using this other, or you're receiving other sources of funding and therefore you need to back out what was previously reported in the CRF, that you can simply make those updates in subsequent periods. Okay. So, since the auditors, and we'll talk about this, will be looking at that reporting, it's going to be very important that from your documentation perspective that you're, keeping track of, what adjustments you're making and such. So, all right, moving on. All right, so just continuing on, some critical things here to ponder. We haven't really talked much about PPP loans here, but it is important to note that since the employee retention tax credit covers only 50% of qualifying wages, the regulations do not allow you to take that other 50% and cover it with PPP loan proceeds. Okay, so very important distinction, and that's something to note as well as part of the updates with the Consolidated Appropriations Act passed in December. Before that, you were not able to, one entity was not able to obtain a PPP loan and an ERTC, but now that's retroactively changed. So one entity can obtain both. But again, avoid double dipping, avoid those extra wages that weren't covered with a credit and applying it to PPP loan. You have to really factor that in, okay? All right, so continuing on, in regards to how you report these tax credits in the financial statements, there really is no clear GASB guidance on this, since the tax credits, since these tax credits are not available to federal and state governments, we really don't expect any formal updates by the GASB on the accounting treatment of these transactions. But we have had discussions with David Bean and other of the GASB staff as well on trying to figure out the most appropriate approach to recognize these transactions in the financial statements. And overwhelmingly, they say that really when you receive the reimbursement or when you have to accrue the receivable at the end of the year, you should be netting that with the related expenses. Now, we have heard of others that have simply said, look, it makes more sense to report it in their business as other non-operating revenues. Again, there's nothing saying that's right. There's nothing saying that's wrong. It's just based on what we've heard, the more preferable option is to credit the expenses. Okay. All right, let's talk real quick about some of the other impacts of going after some of these funding sources to other operations of the tribe. So if you find costs in your indirect cost pool and you find that they're either eligible for the CRF or for these tax credits, and as a result, of course, this would reduce your overall IDC pool expenses, right? You might have to consider that if that occurs, you will have a lower indirect cost rate in future years, which would potentially negatively impact the reimbursement you could receive. Again, when you're factoring all of this in and really strategizing your funding, that's important to address. If you are able to utilize the tax credits for payroll that was previously charged to other federal grants or to the CRF, again, you're going to have to consider how to rebudget or reallocate those costs to other eligible expenses. And then also, too, the administrative effort, you need to factor that in, because amending the 425 reports too might be a significant hurdle as well. If the tax credits reimburse payroll charged to grants that had any type of period of availability, deadlines, or budget restrictions, you might need to also request extensions or budget reallocations from your federal agency as well. So again, it's just, I probably most people realize that on this call, but a lot of things to factor in if we're going to take advantage of these credits, okay? Okay, Emily, I think we have our next polling question.
Yep. Our third polling question: has your tribal government or business received the ERTC or the Families First tax credit? And your options are A, we have completed the necessary 941 forms that either received or are waiting to receive our reimbursement. B, we are compiling the information or about to start the process of calculating our credits. C, we didn't have very many employees' wages that would meet the Ertc or the Family's First tax credit criteria. Or D, we've done nothing yet.
I can't wait to see the answers to this. How many people on this call have factored this in? I know that Ertc, if you've been talking to us, there's no question that that's been available. But Families First, it's just such an opportunity to maximize this type of funding. So,
a couple more seconds here.
We have received a lot of good questions on this, and we're hoping to answer all of the questions at the end of the presentation. And if we can't get to it, we'll definitely email you back. But we're hoping to address all of these really good questions before we end the presentation.
All right, let's go ahead and see what everyone had to say.
Okay. So perfect. About 16% have completed the necessary forms and in that process. Good to hear, right? And then a good 28% are compiling the information, kind of getting things ready. That's kind of where I see most of my clients is kind of in that level there. Yeah, the 12%, we didn't have very many employees' wages that would meet the Ertc or the criteria of the Families First. Yeah, I could see that. And 12% of people right now on the webcast, that's about what I would expect. This isn't really going to apply to everybody, but for a vast majority, this could be significant funding. And, I'm thankful that 44%, that if you haven't done anything, I'm hopeful you'll get a lot out of this. And again, like Anita mentioned, there's been some really good questions asked. So hopefully we can get to all those before it's over. But you'll have our contact information. Could easily talk to you about this afterwards to go over your next steps. So I kind of thought that was expected here. All right. So I think what we could do now is move on to talk a little bit about some of the other changes and updates to other funding sources real quickly here. FEMA, there have been a few updates to FEMA lately as a result of some of the additional FEMA restrictions on COVID-related costs that were addressed in a letter from FEMA back in September. It's really been even more challenging to seek FEMA reimbursement. I've witnessed it. It's a painful process, right? Overall, only about 19% of tribes have utilized FEMA COVID funding so far. All right, so this is definitely an area that, it's nice to see that there's going to be some updates here as well. So, for example, the president did issue the following two executive orders on January 21st and February 2nd that make the FEMA reimbursement for COVID-related matters a bit more appetizing. But it's also important to note, we're going to cover that in here in a sec, but it's also important to note that the new $1.9 trillion stimulus plan that's being debated right now, it is expected to be, there's going to be additional assistance through FEMA. I believe what they're talking about is about $50 billion to fund major disasters, but then also to allow the reimbursement of funeral costs. So good to see that type of relief coming for FEMA, that see what happens with this new stimulus plan. So let's talk a bit more about some of the significant actions that will impact tribes that occurred in these two executive orders. So the first thing right off the bat is that this 100% cost share that the federal government will take on for FEMA, in my opinion, is significant. It does go retroactive back to January 20th of last year. So if you've applied any of your CRF monies to that old cost share of 25%, you can now reverse those cost shares out of your CRF fund and seek reimbursement for this amount from FEMA, because it's retroactive. So good to see that. And then on the second bullet here, the executive orders do acknowledge what this assistance could be provided for. And it kind of expands it a little bit more by talking about the safe reopening of eligible schools and child care facilities, healthcare facilities and such. But specifically mentioning domestic violence shelters and transit systems, I think that, that again, that was something that expanded here that makes FEMA a bit more appetizing. And then finally, at the end here, the FEMA will be providing advances of the federal share on a percentage of the expected reimbursement from FEMA-approved projects. That's good to see. Just whatever the federal government could do just to expedite the money that goes in. I know previously there's been FEMA provided in advance, but it looks like they're going to tackle that and make that a little bit more easier from an administrative perspective. So good to see that. All right, Emily, I think we have a polling question next.
All right. Our fourth polling question, where in the process is your organization with FEMA reimbursements? And your options are A, we have already submitted our 100% reimbursement request to FEMA. B, we are planning to take full advantage of a 100% federal cost share. C, we are about to start the process. Or D, we don't think FEMA would be beneficial to our organization. On a couple more seconds here. All right, let's go ahead and take a look at the results.
My gambling skills, I should do this professionally. I could have expected that D, 50% or more would you hit that target, because I get the general feeling that is the concern. And so I'm hopeful that perhaps easing up these restrictions or looking at other assistance that's available through FEMA, maybe it is something to consider. I do know that when I work with tribes that have people dedicated to addressing FEMA, that deal with FEMA on an almost weekly basis, it's painful. It's hard. And, those people are treasures. It's good that they are able to make that work. But again, as I mentioned before, only 19% of tribes have really taken advantage of FEMA so far during COVID. So it's really kind of unfortunate.
All right.
Yeah.
Well, our next topic is this new Treasury Emergency Rental Assistance Program. But before we move on to that program, since we received so many questions on the tax credits and a couple questions on FEMA, how about, Ryan, should we go through some of these questions?
Yeah, I think we've answered some of them here. I'm going to try to go through some of them here. Wow, there's some really good ones. We might not be able to get to all of these. Would we deduct the entire admin leave from grant solutions? So let me get to that. So that's a good question, kind of going back to the tax credits and then the admin leave that you had already applied to your CRF fund. You only need to deduct out the CRF amounts for that admin leave that weren't, you'd only deduct out the ones that you're getting other alternative funding sources for. So not everything, right? So if you still have, like in our example, you still had about a half that needed to be charged to Treasury, it's certainly appropriate and eligible to just allocate half of that or reallocate half of that, however much you came up with your tax credits. Okay. There are a couple others here, Anita. Should the ERTC be entered as a decrease in expenses or miscellaneous income? I know we did address that during the presentation, and there's really no GASB that tells you yes or no. But what we have heard from our consultations with them is that the decrease in expenses is the most preferred. However, we do have clients, we have seen others that want to include it in miscellaneous income for various administrative reasons. And again, nobody has said that that's right or wrong. It's just the preference at this point.
Right. And for tribal businesses, we would expect to see that in the non-operating income if they're not going to reduce their expenses.
And one last question here, Anita, that I could ask answer before we move on, and maybe we could save some of these to later because I know we have a lot of content here. So the question is regarding sick leave. In this particular tribal government, only accounted for sick leave during 2020. However, they were curious if the rules still apply for 2021. So the Consolidated Appropriations Act that was passed in December did extend the Families First sick leave, family leave through March 31st. But with the new stimulus plan that is going through and being debated right now, that date is likely to be extended through the end of September of 21. So it's nice to see that.
Yeah.
Okay, Anita.
All right. So before I start talking about this emergency rental assistance program, we have a fun polling question for you.
All right. I know I've been thinking about this a lot. Our fifth polling question, where is the first place you'll likely visit when the pandemic is over? And your options are A, anywhere, get me out of here. B, tropical islands. C, my local restaurant. Or D, nowhere, I like staying home.
For me, it would be A or B.
Oh my gosh, tropical islands sound nice right now. I'm getting blanketed with snow right now over here in the West, and boy, Hawaii, oh, get me out of here. That makes sense.
All right, let's go ahead and see what everyone has to say.
All right. So, like these results. So, the Treasury Emergency Rental Assistance. So when the Consolidated Appropriation Act was passed on December 27th, 2020, sorry. The act is called 2021, but it was passed on December 27th, 2020. They allocated $798 million for Indian tribes and tribal designated housing entities. And the purpose of this program, of this ERA, or Emergency Rental Assistance Program, is to assist households that are unable to pay rent or utilities due to the pandemic. So rent is specific to, rental related to residential dwellings, not to homeowners, so it doesn't cover mortgage payments. And utilities it covers the normal utilities of electricity, gas, water, sewer, trash removal, energy costs, including fuel oil, but it does not include other telecommunication utilities like telephone, cable, or internet. And tribes and designated housing entities can provide eligible households up to 12 months of rental assistance. And if they feel that there are households that need additional assistance due to housing instability, they could provide another 3 months to them as well. It's a pretty generous program. And for those tribes or tribal designated housing entities that opted into this program, they should have received or should be receiving soon approximately 121% of their 2020 Indian Housing Block Grant Formula allocation. Now, to provide assistance under this program, tribes and tribal designated housing entities will have to set up an application process for this program. And the goal that Treasury has is that they want tribes and designated housing entities to make these payments directly to landlords or utility service providers. And they even go on, the Treasury goes on to say that you have to make efforts to get to the landlords and utility service providers to participate into the program. And if they don't participate in the program, then you can directly pay eligible households for this assistance. However, if you do directly pay this assistance to households, you'll have to document the efforts that you made. So they give an example of sending certified mail to landlords and utility service providers, and they say that you have to document those efforts because they'll want to see that you tried to go that route first, and if they didn't respond or they chose not to participate, then you provide assistance directly to households. They even say that they're allowing 90% of this funding can be used direct for assistance for households, but up to 10% of it can be used for administrative costs, including paying for the certified mail. So they're putting that allowability, that earmark there of up to 10%. So how does a household become eligible to receive this program? There are 3 criteria they have to meet, and it's at least one or more individuals in the household will have to meet this criteria. One, if they qualify for unemployment or have experienced reduction of income or have incurred significant costs or other financial hardships due to COVID. The other criteria is that one or more individuals are experiencing homelessness or housing instability. And 3, the household income is at or below 80% of the area median. Now, this third bullet, I think, could create a barrier for some households that would otherwise qualify, especially in the time period in 2020 if they received additional unemployment assistance in 2020 or other types of assistance. It's too bad that they came out with this program in December of 2020 because quite a few tribes may have already provided assistance to members for housing and utility assistance. But this program goes all the way to the end of 2021, so you can strategize on if there are households that meet this criteria, you could strategize on using this program first specifically for rent and utility before you provide other assistance to them. The last part here is that you have to make sure you're not duplicating the assistance you're providing. So if they're already receiving rental assistance from another federal source, they can't also receive federal rental and utility assistance to this program. So similar to the CRS program, the Treasury they issued FAQs on this, and what we're hearing is they may even have more FAQs coming out for this program in particular. But I wanted to point out 2 FAQs I thought were super helpful. One, can the tribe or the tribal designated housing entity be the payee for the program? So the FAQ that I've copied here specifically says that yes, the grantee, which would be the tribe or the tribal designated housing entity, can provide assistance to households for grantees in which the landlord is providing the grant. So it would be similar to basically revenue replacement for any rental assistance programs that the tribe or tribal designated housing entities is operating. And unlike the CRS that specifically says you can't have revenue replacement, this one would allow for that. And then there was also a question that we received on this about, well, can this assistance be used for 2020, even though this was issued on December 27th of 2020? And they do say that it can be used for rent arrears from March 13th, 2020 onwards to the end of this year of 2021. So I think this is a program that I'm hoping a lot of tribes and tribal designated housing entities have looked into. All right, now we've talked about strategizing the use of payroll tax credits. We've talked about the additional cost share with FEMA. We've talked about this new emergency rental assistance program. Now, switching gears, we're going to be, especially as auditors, Ryan and I want to share with you what we're seeing about the requirements of what your CRS audit would entail. Because for a majority of the tribal governments, your CRS program will probably be a major federal program for the purposes of single audit. So we wanted to share our thoughts on what we're looking at on this. Before that, though, we have one more polling question.
All right, our final polling question. Where is your organization in the single audit process of your CRF program? And your options are A, our FY 2020 single audit is completed. B, our single audit is underway. C, our single audit hasn't started yet. Or D, I'm not sure if we're required to have a single audit. So we'll give everyone some time to think about that.
Yeah, for fiscal years 2019, we know a lot of, because of the pandemic, there are valid reasons why a lot of the 2019 audits were delayed and probably got issued at the end of 2020, or some are probably going on in 2021 as well. So I wouldn't be surprised if 2020 is still, the audit hasn't started or it's just underway. Regarding all right, Emily.
Well, let's see where everyone's at.
All right. Okay, so kind of as expected, regarding the last bullet there, I'm not sure if we're required to have a single audit. We will be talking about that next. So before we even start talking about what the audit will entail, what the CRF audit will entail, I want to clarify something regarding, specifically for tribal businesses, the beneficiary versus subrecipient discussion. So the Treasury Department responded to a letter from the FOA that clarifies that if a tribal business, regardless of whether the business is an enterprise fund or a legally separate component unit, is a recipient of a beneficiary program set up by the tribe, it would be exempt from single audit or program-specific audit requirements. The Treasury seems to be more focused on the nature of the assistance that is provided rather than who it was provided to. So for example, if a tribe provided direct assistance to their casino to cover business interruption costs, and they're not providing assistance to the casino to run a program on behalf of the tribe, then the casino would just be considered a beneficiary of the tribe's program to cover business interruption costs and would not be subject to the Single Audit Act. On the other hand, if a tribe provided CRF assistance to its separate housing authority to operate a new emergency rental assistance program on behalf of the tribe, then the housing authority would be considered a subrecipient of the tribe. And if a subrecipient spends over $750,000 of federal funds, then it would be subject to the Single Audit Act. Now, if your tribe provided any assistance to its businesses and your documentation said that the business was a subrecipient, because that is what the knowledge we all had as of last summer, but by the nature of the assistance, these are not actually subrecipients, but they're beneficiaries, or casinos just getting the reimbursement for their business interruption costs, or other businesses are getting that, then you may want to update your documentation to clarify that those businesses are beneficiaries and not subrecipients, and also, communicate this to your businesses as well, so they're not, worried about going through a single audit. Now focusing on OMB. So around the holidays, in December 2020, OMB finally issued its addendum that outlines the compliance requirements it wants auditors to test for the CRF program. A couple pieces of good news here. First of all, OMB did not create any new requirements. It instead just pointed to Treasury's guidelines, its guidance document, its FAQs, and its other FAQs on reporting and record retention. And the second part, which I think is the biggest deal, is that OMB acknowledged that federal agencies during the year updated or changed or maybe deleted some specific guidance over time. So OMB is saying to auditors that an auditor may conclude whether the tribe is in compliance with the requirements based on consideration of the guidance in effect at the time of the activity or transaction. So this is really good news, because we all know Treasury added its FAQs and guidance documents throughout the year, especially for the CRF program. And for example, some tribes provided individual assistance to its citizens and members based on the initial Treasury initial guidance and FAQs that Treasury released on April 22nd, tribes may have provided this assistance without an application process. However, on June 24th, Treasury released new FAQs, and it said that actually they should, there's a requirement of performing an assessment of individual needs. So auditors should take that timing of the decision made by council into account of when they decided to make this payment to citizens, and then audit them based on the timing of the decision and what guidance was out at the time. I'm hoping this is probably a relief for some tribes. All right, now focusing on what OMB wants auditors to test. Here are the list of requirements, starting out with allowable activities, allowable costs. Both of those are focused on, in both of those cases, for both of those compliance requirements, OMB has pointed auditors to just the Treasury guidelines and FAQs, so no new requirements there. We also heard some good news just a few days ago that Treasury does not expect to issue any more FAQs or changes to guidelines on the CRF program. I think they may answer questions individually if tribes send an email to them, but they're not planning to update their FAQs. So that's a big relief for all of us. But 2 points I want to point out on this allowable cost section. One, if you purchased real property or equipment with CRF money, OMB is emphasizing that you must have documentation that is showing that it was more cost effective for you to purchase the asset versus leasing or using existing facilities to meet the purpose related to COVID. And I just heard yesterday that Treasury OIG actually, based on a tip that they received, they reached out to a tribe and started asking questions on the reason for a purchase of a property. And apparently Treasury OIG was very adamant that the tribe must show documentation on this cost effectiveness, that, the tribe did look to see if there was, it would be more cost effective to purchase versus leasing or improving existing properties. So please do make sure you have that documented. And the second part, and I'm sure if my clients are on the call here, they're sick of tired of me sending emails about this, hazard pay. Treasury guidance is very narrow when it comes to the allowability of hazard pay. So tribes can only charge hazard pay they can only charge hazard pay to the CRF program only if an employee is performing hazardous duty or work involving physical hardship, and this work is related to COVID-19. So typically, finance employees that are not working on code-related matters and that are not required to interact with the general public would not qualify for hazard pay, even if they were considered essential workers and had to go into the office during the pandemic. So please do be very careful about what the hazard pay piece of this, and just documentation in general is always very important. And now Ryan will go over the remaining compliance requirements.
Thank you, Anita. So a couple more here with the period of performance. Of course, this has changed, right? The compliance supplement does say CRF program's period of performance for expenditures incurred is March 1st through December 30th, 2020. Although that says that in the compliance supplement, obviously with the updates in December with the Consolidated Appropriations Act, that's now been updated to December 31st, 2021. So again, I guess at this point, I'm not as worried about, the time period of December 31st, 2021. I guess that'll be for the next audit cycle. But I think where some might get caught up on is that March 1st date. And again, we're talking about when expenses were incurred. And so I can see in some cases where, we have March 1st, we have the payroll registers for admin leave or some kind of eligible costs for employees that were substantially dedicated to addressing the pandemic that are eligible for CRF. We might simply get the payroll register for that beginning portion of March and say, okay, we're applying that to the CRF. However, it's important to note that, again, that payroll register might be for payroll that was incurred before March 1st. So, little hangups there. I just, we always focus on the end date, but the beginning date here is going to be key as well. And on the reporting side, auditors will be testing your reporting. And these are these areas here that we've kind of detailed out in the slide deck is what Treasury wants us to look at as auditors. And, some of this, like the amount of funding received from Treasury, if I'm not mistaken, I think that's automatically in the grant solutions reporting. So it's not like you can change that, but it's one of the things they want the auditors to look at. Amount of funds expended or obligated for each project or activity, detailed listing of all the projects and activities, names and descriptions. And then just making sure with those 4 categories where it's a loan or a contract and a grant or transfers or direct payment, that all those appear appropriate. So those are some of the areas that OMB wants auditors to look at. I think, again, I hate overemphasizing this, but it's important. Documenting how you prepared your grant solutions reporting, having that available for the auditors. If you have subsequent adjustments to reporting, it's important to show why. Of course, that's allowed, like we talked about before, but the fact is that you want to be able to acknowledge in the documentation why that occurred. So. All right, moving on here, getting close to our time. So I want to speed up a bit. Just a couple other things, too, on subrecipient monitoring. Anita had previously discussed the difference between a beneficiary and a subrecipient. However, if you have subrecipients that you've provided the CRF money to, these are some of the requirements over subrecipient monitoring that the auditors are required to look at. So, you as a tribal government having subrecipients need to be able to communicate to the sub the applicable requirements, the award details. You as the government or the prime recipient would need to evaluate the risk of that particular subrecipient. What are their concerns of noncompliance? Do they have adequate safeguards and internal controls in place? And then third, what are you doing to monitor, compliance, right? So if that's simply, reporting that you're asking for from the sub, or you're actually going on site and doing a sample of expenditure reviews, it's important, again, having a simple checklist that addresses what you did is going to, and it could be in a memo, something to show what you did and how you acknowledge the risk of that particular subrecipient. And then finally, on this last bullet, if the subrecipient does expend more than $750,000, they may be subject to their own single audit or program-specific audit. So just keep that in mind. And finally, so I know Anita brought this up earlier too, but OMB has extended audits for those entities that receive COVID funding, which, in most cases would include all tribes. Well, it includes all tribes because of the COVID funding and CRF funding received. But it's important to note that for tribal entities that maybe require a single audit but didn't receive any COVID funding, they would not be eligible for these extensions. So, so if we look through here, your fiscal year, I think the most important thing here is that, we're just simply adding 3 months to the original audit extensions. But the big key here is if you have a December 31st, 2020 year end, you have no extensions. It is going to stick to that 9-month requirement. Your audit is due 9/30/2021. So that's really unfortunate, but all these other fiscal year ends provide a bit more relief. All right, so other available funding for tribes. Again, these two programs came out as part of the Consolidated Appropriations Act signed back in December. The Shuttered Venue Operators Grant is a $15 billion program that is administered by the SBA. The amount of the grant really has restrictions, but can be sizable to the lesser of $10 million or 45% of the 2019 gross revenues of the entity. But since it's silent on tribes in the guidance, trying to think about, okay, what tribal entities might qualify? Could it be tribal museums? again, acting as a standalone entity, or could it be a tribe that has a venue operator that's acting solely, or an entity that's acting solely as a venue operator? I think with those narrow types of businesses, maybe it might apply. But the big issue specifically with museums is that for their revenue calculation, contributions and grants won't be counted as earned revenue. So again, it's available, but I'm not certain how many tribes would be able to take advantage of. But if you think that you might meet that criteria, I definitely look into that. SBA is updating their FAQs on this particular program now. And then also to the Tribal Broadband Connectivity Program. This particular program provides $1 billion specifically to tribes and their related entities. It's essentially providing a way of accessing tribal broadband to address the digital divide across Indian country, which I think is a phenomenal grant opportunity. Right now, the Department of Commerce is seeking out ways to administer the program, and it's hosted a few listening sessions in the last few weeks. But right now, there's just the listening sessions are including how to allocate the funding, how to administer the program. So there's really not a lot of details on this particular program, but really interested when they get the details finalized, who might be available for this program. So very excited about that. Let's also talk about another funding source that actually came through the CARES Act, but really it hasn't been widely adopted. And this is really for the assistance for fishery participants. The CARES Act did appropriate about $300 million to this particular program, and eligible tribal fisheries, commercial chartered fishery participants as well that were affected by COVID. And this particular program may receive direct relief payments for this grant. But as of December 4th, really only 18% of the funds have been distributed for tribes. So it's really been a very underutilized program. All right, so some of the things to really factor in here is on NOAA's FAQs, it does indicate that eligible fishing-related businesses should contact either the state's marine fisheries management agencies or the tribe directly to access the funding. So if you are a tribe in a coastal state, and maybe you haven't heard of this program or you haven't taken advantage of it, this is really it seems like a nice benefit for those tribal members that are in this particular industry to receive additional relief. So it's not allowed for tribes in non-coastal states that might have freshwater fisheries. It's a bit unfortunate, but again, it's mostly focused on the coastal tribes. So again, just real quickly going through the rest of these bullets here, the officials really do expect that by early 2021 that a majority of these funds will be distributed. So they're trying to find ways to, to get this going, to get this program utilized and so forth. So I think, again, if you have this, if you're eligible, getting in touch with them to try to figure out how to take advantage of this for your tribal members would be appropriate. Okay. All right, so the new stimulus plan, right? So we have CRF Part 2, a part of this new plan. And it's really, if you recall, under the CARES Act with the CRF fund that was provided $8 billion to tribes. Now, under this new plan that's being debated right now, $20 billion is really the target to provide to tribes, which is phenomenal, which is great. These funds are going to be, a lot of the restrictions will be lifted. Essentially, they'll be available until expended, greater flexibility in how the money can be spent. It is one of the key things is to replace revenue that was lost based on January 2020 revenue projections. There's other items here too, talking about how money would be distributed. It sounds like the first $1 billion, each tribe would get about 1.7 million. But after that, the 19 billion will be allocated in some degree by the Department of Treasury. I don't know if they would use the same allocation they did last time. I know there was a lot of headaches with that, but it's possible that that could be the case. The CRF extension, the CRF Part 2, that that timing of spending that money by 12/31/2021 has not been impacted by this new plan. But since the uses of these funds are likely to be a bit more flexible than what we previously had under the CARES Act, it's possible that you might have a different CFTA. It'll be considered a new funding source. So we'll kind of keep an eye on that. Another thing, a part of the new stimulus plan was the Restaurant Revitalization Fund. Very, very interesting to see that restaurants affected during the pandemic. And in the language of the stimulus plan, it does mention specifically tribally owned business concerns as well. So this program will provide about $25 billion in grants to support these revenue losses from restaurants. About $5 billion of that is really going to be set aside for the smaller restaurants that have under $500,000 in revenues in 2019. And then the other $20 billion is for various restaurants of various sizes. It's good to know with this particular fund or this opportunity that in the first 21 days that the grant is available, they're really going to prioritize minority, veterans, and those tribal concerns. So I think, the fact that they do have language about tribes in here, I'm hopeful that, there's not going to be any significant restrictions that require the restaurant to be a separate legal entity, but we'll see where that comes out. And then finally, the other items worth noting here, there's going to be a lot of funding for about $15 billion for child care development and $24 billion for child care stabilization for child care providers that include tribes and tribal organizations. Another $6 billion is going to be targeted specifically for tribal health programs. Definitely a lot of money going to the BIE for schools, $850 million, $750 million for housing and supportive service assistance for tribes. And the last one here, which is great to see, there's about $10 million that will be provided for Native American language preservation as a part of this bill. So really, really good stuff here. That just hard to highlight a $1.9 trillion plan, but we try to do our best. All right. We have 3 minutes left.
All right. And we can probably squeeze in at least one question here. As both Ryan and Anita have said, we have got a ton of questions today, and we will be doing our best to follow up with you after the webcast if we don't get to your question now. And let's start with, if we had a similar program under Treasury funding, however, those funds are completely exhausted, can we use these funds for new applicants who meet criteria? This would not be duplicative, would it?
Right. I don't believe that would be duplicative because they're not getting paid for the same rental, for the same assistance in the following months. So if you exhausted one program and now you have this new program to fund them, that's perfect. It's not duplicative.
Great. Thank you.
Emily, I'm sorry. Let me just real quickly address one of the questions that came through here. I think this is important.
Sure.
Someone asked in regards to that fisheries program that the Great Lakes fisheries were specifically mentioned in the fisheries grant. If that's the case, I didn't see that in NOAA's FAQs, which talk about this particular issue. But if that's, if you are a Great Lakes tribe, you have fisheries there, definitely look into that. That might obviously be extremely important to consider.
Thanks, Ryan. And we are just about out of time here. Again, so many questions came in, great questions, and we will be following up with you after the webcast. You can also reach out directly to Anita or Ryan. Their contact information is here on the screen. Thank you so much, Anita and Ryan. Amazing job today. Certainly had a lot of great content to cover. We got everything in by the skin of our teeth. And for our attendees, as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.